Hello traders, and welcome back to Explain the Charts. Today is Sunday, November 23rd, 2025, and as we gear up for a new trading week, we're taking a deep dive into AUDUSD. This pair closed the week around 0.6453, and it's facing a very interesting mix of fundamental signals. On one hand, the latest news shows strong domestic data from Australia, with preliminary PMIs for manufacturing and services both indicating economic expansion. Normally, this would be bullish for the Aussie dollar. However, the Reserve Bank of Australia is maintaining a cautious stance, suggesting interest rates could remain on hold for an extended period, which tempers some of that enthusiasm. On the other side of the pair, we have a broadly weaker US dollar. This is due to increasing market expectations that the Federal Reserve will cut interest rates in December, with the CME FedWatch tool now indicating a 36% probability. Recent U.S. labor data was mixed, with non-farm payrolls beating expectations, but the unemployment rate ticking up to its highest level since 2022, adding to the rate cut narrative. Despite this USD weakness, AUDUSD has been struggling to gain traction, which tells us that broader market sentiment and technical factors are heavily at play. Analysts are even forecasting potential record lows for the pair in the long term, citing central bank policy divergence and the looming threat of a global trade war. So, with this conflicting backdrop, let's turn to the charts to see what the price action is really telling us. Looking at the daily chart, the big picture is undeniably bearish. Since peaking just below 0.70 back in late September 2024, the pair has been in a clear and consistent downtrend, defined by a series of lower highs and lower lows. This is the dominant trend that all traders must respect. We can see a significant drop that bottomed out around the 0.62 level in December of last year. The market has since seen some recovery and has been consolidating for most of 2025, but it has failed to make any sustained break to the upside. Notice the extreme lows from January and April of this year, which represent moments of peak fear, but also serve as long-term support markers. Now, let's zoom in on the price action over the last 3 months, starting from September. We can clearly see two major attempts to rally that were aggressively rejected. The first was in late September, where the price hit a high of 0.6937 before being sold off sharply. The second attempt in mid-October also failed to sustain gains, confirming the area around 0.66 as a very strong resistance zone. Throughout November, price has been trading in a much tighter range, roughly between 0.6450 and 0.6550. Last week's price action is particularly telling. The market pushed up towards the top of this range early in the week, but was rejected, and Friday's session closed weak, right on the edge of this consolidation support. This shows that sellers were in control heading into the weekend, creating a bearish posture for the upcoming week. Switching to the 1-hour chart gives us a more granular view of last week's battle. Here we can see the rally attempt that started on Monday, November 17th. It peaked on Tuesday near 0.6518 before momentum completely stalled. What followed was a slow grind lower, which accelerated into a sharp breakdown on Wednesday and Thursday. The price found some temporary footing around the 0.6420 mark. Friday's session was spent trying to stabilize around the 0.6450 area. This level is now the immediate pivot point to watch as the market opens. It was previous support within the range, and a failure to hold above it will likely see sellers take charge once again. A sustained break below this level at the start of the week would be a significant bearish signal. Conversely, if buyers can defend this zone, it may suggest another attempt to test the higher end of the range. Drilling down to the 15-minute chart for Friday's session, we can analyze the character of the latest price movements. After the low was set around 0.6418 in the early hours, the price did manage to climb back towards 0.6453 by the end of the day. However, observe the nature of this bounce. It was a choppy, grinding recovery, lacking the impulsive, high-volume characteristics of a genuine trend reversal. This price action looks more like consolidation and potential short covering before the weekend rather than the start of a new bullish leg. This short-term weakness reinforces the bearish bias we see on the higher time frames. It aligns well with some forecasts suggesting a minor bounce to test broken support, followed by a continuation of the downtrend. The inability to reclaim higher levels with conviction on Friday is a red flag for the bulls. So, let's recap and look ahead. The key levels to watch are critical. Immediate resistance is the 0.6450 to 0.6460 pivot zone. Above that, we have minor resistance around 0.6510, with the major ceiling remaining at 0.6550. To the downside, initial support is at last week's low of 0.6418. A break of that level opens the door to the psychological 0.6400 handle, and below that, the next significant structural support is around 0.6330. Now for our unbiased predictions. The bearish scenario appears to have the higher probability, which I'd place at around 75%. The path of least resistance is down, supported by the multi-timeframe trend and the weak weekly close. If the market opens and fails to reclaim 0.6460, a test and likely break of 0.6418 seems imminent, targeting lower levels in the days to come. This would be reinforced by any risk-off sentiment in the broader markets. The bullish case, with a 25% probability, requires a strong defense of the 0.6420 low. For bulls to gain any real control, we would need to see a decisive break and daily close back above 0.6510. This would trap sellers and could trigger a squeeze back towards the 0.6550 resistance, but it would likely need a strong fundamental catalyst, such as very poor US data. So, as the week begins, watch the market's reaction to the 0.6450 pivot. Also, keep an eye on the upcoming US PMI and consumer sentiment data for potential volatility. That's our analysis for today. Thank you for watching Explain the Charts. Please remember, this is not financial advice. All content is for informational and educational purposes only, and you should always conduct your own research before making any investment decisions.